everyone, and welcome to our first 4x4 virtual salon of 2025. The theme for today is the year ahead for growth and pre-IPO stocks. As anyone who has previously attended one of our 4x4s will know, the 4x4 gets its name from the fact that we tried to combine in 1 hour 4 topics with 4 audience questions, 4 polls, and we have 4 speakers. So please look out for the polls. They're going to be made available from the start. And if you have a question, please put it in the Q&A, and I will put it to our speakers. Our speakers are, okay, so top left, at least in my screen, we have Karine, Genevey, who is an independent board member and who was formerly head of North America and head of alternative assets at Pictet, which is one of the world's largest private banks and independent investment managers. And top right, we have Nicolas, Colin, who is the co-founder of The Family, which is an incubator and venture capital firm founded in Paris in 2013. And he also writes a weekly newsletter that I can strongly recommend called Drift Signal. Bottom left, we have Andreas Bezner, who is co-founder and CEO of Stableton, the go-to partner for institutional investors looking to invest in private markets. And then last but not least, we have Simon Taylor, who is head of content and strategy at Sardine, the market-leading AI risk platform, and who also writes a much recommended weekly newsletter called FinTech Brain Food. In the next hour, as mentioned, we're going to try to cover 4 topics. Those topics are, number 1, are IPOs in secular decline? Number 2, should every diversified portfolio have an allocation to private markets? Number 3, the best practices for investing in private markets. And lastly, the outlook for private markets over time. Okay, right. So to kick off the first of our 4 topics, I'm going to come to you, Karine. The section is around are IPOs in secular decline. And the first question is, what are the reasons that we've seen for the decline in IPOs globally over recent years?
Yeah, great question. It's been, a lot commented in the press, and I think there is a global story, and then there are circumstances, reasons and circumstances right now. So historically, we know the story of, how we've had big incentives to have private funding because it was easy to get that funding, and then you had the ultra low money policies of 2020, 2021, which even gave more dry powder to private equity firms. On the other hand, we also have a regulatory context with the fact that, we've separated the broker research from investment banking, which is to protect the investors, but basically we've damaged a lot the liquidity in small and mid cap, right? So these people have gone to private equity. Now, if you look, in fact, at the detail of the IPO flows, it's in fact very cyclical. So you have peaked in before the dot-com 1999 was a big peak. You had peak in 2007, just before the global financial crisis, and 2014, and then most recently in 2021, which was one of the record years before everything came to down to almost zero. So it is a cyclical story, and there is a demand and supply story in the fact that in the very recent years, we've seen something that has not rebounded with the market. So that's probably the one thing that we notice, is that we've had the S&P rallying, right, since the lows of 2022, maybe 70%, and then the IPO market has not picked up with that, which was the usual that we were used to. And what I have to say is the rally that we've seen in the S&P has been quite concentrated. So actually, you've only seen the broadening of that rally in the second part of last year. So it's a good sign. And also, there've been very bad IPO stories. So where, even if last year we've had great performances of, the likes of Robinhood, but in fact, they're not so far off. They're just post pre-IPO price. So it's not been encouraging for the companies who have all the luxury to remain private and who can raise billions, as we've seen with OpenAI, Databricks and SpaceX last year. They can provide liquidity to their employees and everything. So there's some comfort to be operating almost like a public company, but in a private manner without the scrutiny of the public markets and the activists and everything.
So Karine, are you saying that it isn't in secular decline, it's just cyclical, or you're saying that it's cyclical but still in a secular decline?
My view is that it is actually just circumstantial right now. I don't think there is circular, because in the end, at one point they need to become public because private equity firms need to exit. The question is at which days that happens. Is it being delayed right now? Is it going to be a trend that we have this delay going forward? But the history and the data, if you look just at the numbers, it's been cyclical.
Andreas, do you agree that it's cyclical, or do you believe that getting more liquidity in secondary markets means that people will stay private for much longer, and ultimately fewer companies will even bother to go public?
Why did companies go public originally? First, they want to raise assets, or they want to provide liquidity for all of their investors. So the funding problem is gone. There's so much cash available for those companies to thrive. And secondly, while IPOs are still a good option to provide liquidity, I think it will only take that route if the companies maybe start to show lower growth and or don't provide the returns that are expected in private markets. So that kind of so if basically a company is not growing as fast as meeting the growth equity VC returns, then they may opt to go public. But otherwise, like the private market secondaries provide ample of opportunities for single investors to exit. So you don't have to force a company to go public just for some investors to see liquidity. So that's a great option. Additionally, there are so many more market participants. It gets easier to transact. Before that, it was always an option, but people didn't really know that it exists and was really cumbersome, and it just get easier. And as it actually gets easier, in my view, I would say there's a coexistence. So pre-IPOs, so IPOs are still important, but secondaries are kind of the new IPO, I would say.
Simon, I come to you because you work for a very fast-growing private company. You don't have to tell us if you're thinking about an IPO, but presumably you see lots of advantages in not being public, right?
And with every founder and investor I speak to in my day job, right? Fundamentally, if you look at the data, the companies are staying private for longer because there is so much more capital to be able to do that. What was NVIDIA's first VC round and only VC round was for $2 million. Like the type of pricing at the early stages that was available 20, 30 years ago just does not exist. Now you're seeing companies raising $100 million seed rounds because they've got the word AI slapped to them. I saw, there are downsides to that. I think HP acquired the Humane pin, which Sam Altman invested in, which, if you remember, was going to be the revolutionary AI device. So there are pros and cons, but fundamentally the point is there is just so much more liquidity allowing companies to stay private longer. And the evolution of the crossover fund has been kind of the big thing of the past 20 years, where that growth stage investor that was preparing you for IPO can help you stay in the private sector for a lot longer. And the private equity as a asset class is now broadly traded, and secondary is fairly widely available. So that has really created a whole series of advantages for founders who are still in growth mode. Because even the NASDAQ still has the scrutiny on profitability, EBITDA, underlying. They're not looking for the story or the narrative. There's a broader set of investors, broader set of analysts, and you're opening yourself up to a zoo. Your data room is a public sort of record versus something that's privately shared with a few people who might get to have opinions on it. So you do lose some element of control. But you also get the cachet of being in the public markets, of having the stock ticker. And that is not to be underestimated, of having that moment and what that can do, especially for consumer brands. So It depends what you're building, and it depends if you're still in growth stage, because I fundamentally believe that the types of companies that we've been able to build by staying private longer, right? Would Stripe have been allowed to get away with the amount of building they're doing of new products that are outside of their core area? Would SpaceX even exist if they'd have had to IPO, or would they have had all kinds of regulatory pushback? So it's created a type of growth, but because there's a market there now for professional investors, at least, to get access to this, then great. But of course, person on the street has lost out, because all of that value has been created and captured long before these companies get to the public markets. And that
not necessarily, right? So I was going to ask Nicolas the next question, but I have to ask Andreas this question now, right? Because is it going to be like, actually, this is our first, you guys can probably see it too, right? We've had our first audience question, right? And is it going to be possible, Andreas, for more sort of retail investors, ordinary investors to get access to private markets? So the question is, will the trend of easier access, index funds, and systematic investing, like we have seen in public markets and crypto, also apply to the pre-IPO market?
Yes, when I try to see where the market is going, I'd like to go basically to other asset classes and try to find analogies. And so if you look at how equities, public markets, stocks developed over the last 20 years, it went completely from mostly active and discretionary to 65% plus going into index funds, passive and systematic strategies. So if you think of like the long-term stock market return is maybe 7-8%, and you already pay a third in active management fees, right? That's just too much. Then just lately in crypto, that happened over maybe 10 years from geeks to mainstream with the recent introduction of Bitcoin ETFs, and basically every bank can provide now crypto exposure to their clients. And I think in private markets, over the next 5 to 10 years, we're going to see a similar development, starting with pre-IPO, because those pre-IPO companies are the natural extension of public markets. So they share many similar characteristics, are easy to understand, they're large enough. And especially we're seeing great interest from banks, wealth managers, family offices, and individuals that want to participate. So there are going to be way more, I mean, right now there are not so many, but there are products that are built that serve all that purpose, have lower cost, so that after fees, investors can keep more, that provide a more liquid solution that the current private markets can. They are mark-to-market priced, so they are not based on stale pricing, etc. Right? We will come to that a little later, but there are kind of plenty of other things to highlight as well.
So thank you very much. So Nicolas, this is a two-part question, right? The first one is, so you've actually used secondary markets quite a bit at the family, right, to liquidate positions in some of your companies. So maybe you could share a bit your experiences, right? And, also kind of what sort of discounts and whether those sort of discounts to NAV have been shrinking over time as you've been doing it. And then the second question I want to ask you was, as a market observer, Simon made the case, I think, for staying private for longer, because there's less scrutiny, you've got more freedom, and so on, right? And I think the word you used was cachet, right? So ultimately, like maybe one of the only and biggest reasons for going public is the sort of is the reputational advantage, the cachet. Like, would you agree with that, or do you also see other reasons to go public?
Yeah, sure. So to your first question, it's true that private companies now have liquidity options in theory. In practice, I think secondary markets are riddled with many obstacles that makes especially true price discovery rare and difficult and often unwelcome. So first of all, price discovery might be an issue for companies themselves. They like to think of themselves as highly valued companies. And when there's a secondary transaction that casts a light on the true price, which might be much lower than the price of the last round, it reflects badly on the company, and they don't like that. So they will try and prevent that from happening. The same is true for investment funds, especially VCs, who like to report to the LPs that they have highly valued companies in portfolio, even though it doesn't really transform into cash sent back to the LPs. And as soon as a secondary transaction happens, they have to discount the value of those companies in their portfolio, which looks like bad news to the LPs. And so there's a kind of conspiracy between involving both the companies themselves and their investors to not cast too much light on the price and prevent secondary transactions from happening for that very reason. They have many means to try that from happening. You often need a board authorization for shares changing hands. You need to go through preemption rights, which are usually granted to the major investors in the cap table. And having gone through that process at least 2 times, I can tell you that it's weeks and weeks and weeks of work, of many emails sent as reminders that, to people that you expect an answer from or confirmation from. Lots of lawyer fees to handle all the process. And in the end, that explains why not that much liquidity is happening on the market. Of course, companies realize they need to provide their shareholders and their employees with liquidity options. So they are trying to organize that, like operating their own private marketplace, issuing tender offers and stuff like that. We have seen the emergence of platforms that are specialized, working with companies to help them like lay the ground for that to work in a smoother manner. But the reality of the market is still very brutal. It works for only a few companies that have high valuations, well-known brands, long runway, and proven growth. If your company misses any of that, it's not well known, the valuation is not that high, the runway is short, or the growth is lackluster. You may work as much as possible on structuring a tender offer and providing liquidity options. No one will take them because no one's interested in your company, even though it might prove valuable over the long term. So what we have is not even a 2-tier market. It's not one tier that can trade on secondary markets and the other tier that doesn't. It's a handful of companies, which we all know, the Stripes and the SpaceXs of this world, and all the rest, that is companies that either are not well known or are trapped on their domestic market, like we have a lot of that in Europe at the moment. Companies that are doing well, but only existing on the French market or the British market or the German market. There's not a deep enough market for those companies to implement liquidity options. So,
So can I stop you there? Because we're going to do something which we've never done before on 4x4, which is we're going to jump from section 1 to section 3 straight away. Because I think, Andreas, I have to give you a right of reply on that, right? Because there's so much that I guess you want to respond to, right? So the first question is it really that hard to get access to liquidity? And then secondly, is it the case that it's only really the largest unicorns that for which secondaries are a viable option? And is that why you've, in your business tend to focus on the largest unicorns? So you have first right of reply, and then everybody else please reply, because Nicolas, you covered a lot there, so we have to break that down.
I mean, I can definitely say that it's not straightforward to do secondaries, that's for sure, because it's kind of still in many cases a Wild West, and you have to look at legal stuff, different share classes, different stakeholders. You have a seller, you've got the company, you've got the buyer, you've got timelines. It's not so straightforward. However, let's say we really understand like what the liquidity is. We're working with all like 100+ sources of liquidity, counterparties, companies, investors directly, platforms, brokers, everyone. And I would say there are at least 30 to 40 liquid companies to build a $1 billion portfolio. And like I say, invest usually 50 million, 100 million per company. That's possible. The problem is though, why hasn't that been done before? On the one hand side, it has just emerged over the last 5 years with a significant value creation by these companies. Secondly, because IPOs were not happening, so investors were stuck in these companies, and then they basically learned that they can use secondaries as a liquidity tool. That's for early stage investors, employees that have 99% of their assets in these illiquid companies, so they want to diversify. But of course, with smaller transactions, they get worse prices. But there are also large investors that want to rebalance their portfolios or show distributions to raise the next funds. So I would say in general, so it's actually possible for the top 30 to 40. There is kind of even a market price. While there's not one centralized exchange, there is a market price. We kind of understand what you're paying for what kind of company. However, then the difference is you just really have to see kind of what you're actually buying. Are you buying common shares, preferred shares, SPV, secondary SPV, even SPV with fees, without fees? So that makes you really want to work with a specialist that understands all of that. But there is liquidity. It's deep, but it's fragmented. Then when it comes to data, over the last 3-4 years, there were a couple of service providers emerging that were aggregating secondary market price data, so that provide an additional information to market participants in order to have informed decisions, but also to price portfolios. We are basically collecting data from aggregators, but we're also systematically capturing the data that we're seeing in the market. And so I would say it's possible, but of course you're sometimes at the mercy of the companies if these are direct secondaries. However, if companies see your value proposition as a buyer, if you're maybe not a family office that transaction every 2 years, but you're continuously providing liquidity, you have all the you're approved, you've got the share transfer notices, you've got all the basically it's super easy to work with you, right? Then they are of course interested to provide liquidity for their employees and the early investors, and these are the ones that matter, right? That have been there from the beginning, and so. But I agree that some companies want to set their prices and then they run company-sponsored secondaries. But even here, for example, we as Stableton, we are able to participate in huge secondaries that are run by large investment banks or the companies directly. However, I think even the better deals are actually in fragmented markets because you've got less competition and less people can transact on them. But there is liquidity for sure.
Karine, I don't know if you also wanted to comment on that.
Yeah, I think it's interesting. So we haven't settled it, but there is definitely a trend for more liquidity in these markets, and this is absolutely crucial. It's actually huge because more liquidity means more transparency. To your point, Nicolas, which in turn means more access for investors. So that is a game changer for your portfolio, where traditionally you couldn't access anything. Now you can basically, as you were explaining before, Andreas has kind of an index part, of your portfolio in there where you risk manage better, you diversify better. In fact, you add access before you didn't even have the exposure. So it's transformational. It will increase when we discussed IPOs before. It's one of the reasons where IPOs meeting public market and private companies meeting public markets valuations was one of the big things. Remember, we worked, right? So it's actually great that we have this price discovery enhanced by the liquidity that is provided before IPO, if ever there is an IPO. But still, there is something ongoing there, which allows investors to access the stage of growth, which has clearly been delayed. Remember, Amazon went public at the end of the 90s. I think they raised, 50 million at the time, for a completely different stage from what we're seeing now with tech companies who are doing all that growth way before they are listed. So you add an exposure which you do not have in terms of stage and sector, I guess, because a large part of the tech sector is below the IPO waterline, by having an access to secondary.
We've had another question here from the audience. By the way, I think we've got a lead for you, Andreas. Seems that at least one person's asking where they can invest in unicorns So we've added the URL here on the chat, which is it's good. But anyway, the question we had, I think this one is best going to you, Simon, at least initially, is what metrics should we be focusing on now that the end of growth at any cost seems to be over? So first of all, do you agree with the premise of the question?
Well, I was going to say, is it? Certainly, a lot of what I do is correlated to the US markets. And whilst there's a bit more nervousness in perhaps recent months post DeepSeek, it's still kind of wild out there. Maybe in the European side, we've always been a little bit more attached to fundamentals than animal spirits. But still, I think the premise of the question of like growth at all costs, certainly growth is still the mandate. And if anything, it's becoming more and more the mandate is where is growth going to come from? And in a European context, that is something that is absolutely critical, which if you turn that on its head, is the key metric is what is your revenue growth? What is your top line growth? Where is that going to come from? How are you managing market expansion? And every business that can show significantly higher than 20% year-on-year revenue growth is interesting. Certainly if it's doing more than 100 million in revenue. Once you get into that stage, I've seen people talking about the famous company Plaid. They do the open banking with its 26% year-on-year revenue growth is anemic, even though they're on something like 300 million. And that is a cap table that's probably a bit of a mess with a wild preference stack done in the height of the 2021 bubble. Like, oh my goodness. So that's kind of where you don't want to be as an investor versus, say, a Revolut, who have got some fairly wild valuations and some fairly wild investors, but they have managed their cap table really, really tightly and been very, very careful about where they've taken secondary. So growth is growth. And how can you lean into that? How can you find that as an investor? And how can you as a potentially smaller investor, smaller family office, my goodness, a retail investor, have the adequate disclosures that you need to be able to make that investment? Because how many of us can get into a data room? All right, I might be able to take a data room and throw it into Claude or ChatGPT, throw it into O1 and see if it can make sense of it and find some stuff. But the sophisticated investor tests under MiFID II exist for a reason. The classification of a retail investor exists for a reason. Disclosure rules exist for a reason. They may not necessarily always be effective, but there is a good idea in there, which is, does somebody understand what the implications of Uber growing versus WeWork growing versus OpenAI growing and how sticky those revenues are, and therefore what that means for the long-term health of that business. So growth is the critical metric without question, but you have to set that in the context of the market it operates in, who its competitors are, what its supply chain looks like, and how sustainable you think that growth is or how cyclical it is. So there's always going to be the EBITDA question. There's always going to be profitability. There's always going to be cost of goods and sales. But for me, if we are looking at growth businesses, where's the growth? And that's always my whiplash effect whenever I travel across the Atlantic is I am drowning in growth everywhere I turn when I deal with the US. And in Europe, there are some really great stories, but we're too shy to tell them and we don't focus on them. And I think if we could create that just really sharp focus around growth, then we'll have much more interesting conversations.
Great, thank you very much. Right, so it's past. I'm going to move us on to what was section 2, now section 3, and I'm going to come to you first, Nicolas. Like, as all of you have said, there's much more value creation happening while companies are in private hands before they become public, if they become public. Given that dynamic, can you afford not to have private markets stocks in a portfolio, whether that's VC, private equity, or growth pre-IPO stocks?
I mean, Sorry, that was for Nicolas, wasn't it?
Additionally, Nicolas, yeah.
Yes, I would say to echo something that was said earlier about retail investors having access to interesting opportunities on that market. I would say that those retail investors are still invested in institutional vehicles like pension funds or insurance companies, or I mean, we're all saving money, and that money is invested somewhere. And statistics have demonstrated that most of that money, a growing part of that money, has been invested in private equity over the past decades. And at this point, we have to challenge the position of private equity representatives or those who have vested interest in this industry, because the critics of this displacement of funds from public to private market argue that it mostly serves the interests of firms who collect hefty management fees from those assets under management. And so obviously people representing private markets and private equity firms don't have an interest in explaining that, no, we don't need as much private markets, we need more public markets. That said, I hear Simon and what he said about growth, but the way I see the market from a macro perspective is that we're soon reaching a plateau in terms of how technology can eat the world. It has eaten a lot of the world, and I don't think it will eat more of it over the next years, because there's not much to eat. We'll still need tangible stuff. We still need to build stuff that's not digital, that's not bits, but more atoms. And therefore, I think we're reaching that kind of plateau where, which is similar to the 1970s in the previous paradigm. The 1970s is when mass production, which was the equivalent of technology at the time, was applied everywhere where it could deliver a result. And in the 1970s, we realized, okay, we have experimented with mass production in every industry. There are some industries where it works exceptionally well, other industries where it's so-so, and finally a tier of industries where it doesn't work at all. And the 1970s were a time when markets essentially stopped growing. And when the market stops growing, you can demonstrate growth at a company level only if you take market shares from your competitors, which requires strategic positioning. So a lot of work on business strategy, much more than what used to be done during the growth phase of this digital economy. And because companies sometimes have a hard time, are so used to being lifted up by the growth of the market, when that growth stops, they can only grow if they're pressured. And in the 1970s, the pressure came primarily from buyout firms who would buy out companies, burden them with a lot of debt, and force them to generate dividends to reimburse that debt. And I think, well, it might seem counterintuitive, but I think we're reaching that point where companies will be forced to grow at the expense of their competitors, not lifted up by the market. They will have to rediscover business strategy. They will be bought out by very aggressive buyout firms. And in the end, what made private markets so attractive, that is the growth of the companies it was backing, those markets were backing, will not really exist anymore. Then
also because
will be a rebalancing towards public markets.
Okay, we're going to drop anchor here for a second, because we're going to talk well, in fact now, about section 4, which is the future of the outlook for private markets. And okay, first of all, I'm going to come to you, Simon. Has software? Do you think software is going to stop eating the world? Do you think we're into this, into a zero-sum game where companies can only take market share if they, or they can only grow if they take market share from their competitors? Or Do you think that AI is the next phase in software eating the world?
Many things can be true at once. AI can be in a short-term sort of a local maxima insofar as its ability to transform the world. And if you zoom out and look at it, it looks like sort of the 1800s rather than the 1970s with the railroad building boom and bust cycle. And we've just been through a boom and we built out a lot of infrastructure, and that infrastructure will not be productive for quite some time. And so there's all of this money being spent on all of these assets that aren't returning anything, and suddenly people want to disappear. So is there a push for buyouts and the humane pain and silly things? Yes, probably. Darwin is not quite dead yet. Darwin will probably have moments in which he makes a wonderful return, and an evolution and fundamentals matter. However, the bigger secular longer term trend is digital is like less than 1% done. And the reason I say that is bits are about to eat atoms in a major way. The next big trend is AI driving robotics. You can spend about $16,000 for a Chinese robot that can run a good chunk of your factory floor. And it's not and you can get it delivered, and it can dance. It's absolutely wild. So as we finally do stick the landing on genuine robotics with computer vision, what that can do to the atomic world and what that can start to unlock, I think, is the next big transformation. So computers were stuck inside the computer. Have we kind of plundered the depths of software as a service? Yeah, probably. There are probably not that many great SaaS businesses left to be built. Is AI sort of reaching a point now where the big companies have probably been built? Maybe, yeah. There could be a few that come in later in the cycle. Who knows? We could yet get a Google that comes after all of the initial .coms and the search engines. But that I would broadly agree with. But the private companies that are the next SpaceX, the next Tesla, that's the wave that's barely just begun. And decentralized infrastructure to revolutionize the rest of the world, rather than fixed infrastructure, is a trend that Starlink shows the beginnings of, but is really nowhere even close to seeing its potential now. Is that a few years out? Are investors going to see returns on that? Is that going to be driving revenue tomorrow? Are they going to be tomorrow's big growth companies? There's always a difficulty with these things, which is timing. But I'm a lot more confident on the prospect of great private companies being built with a software mindset that operate in the atomic world than I am when that will happen.
Andreas, do you agree? And I'm going to refer to our audience poll here. So the second biggest reason people cite for wanting to invest in private markets is to get access to all of those things that Simon just said, right? In terms of all these new cutting edge trends, AI and so on. So do you agree with what Simon said? And also, did you agree that, coming back to the question of whether every portfolio should have an allocation to private markets, that you basically have no choice but to have an allocation to private markets if you want to be capitalizing on some of these major secular trends?
Yeah, I've got like so many things that I'm basically I see differently. First of all, let's say in Switzerland, the pension funds invest maybe 1%, 2% in private equity, and they could afford to invest really for the long term. Secondly, like the main correlation that drives stock market returns is revenue, or individual stock returns is revenue growth and then associated earnings growth. So if you can invest in companies that can, for like the foreseeable future in the next 10, 20 years, outgrow other companies, I mean, they should be deserving these prizes. I mean, I don't see a reason, for example, why Revolut wouldn't become at one point in time the world's largest bank, or most valuable bank, just right. And equally for every other company of our top 20 company. And of course, if you just take an average, then the average can grow like with 20, 30% over the next years. But you have like these kind of pockets of growth where they're just so much better than the rest, and they can really sustain the growth for 20, 30, 40% over many years. Like our portfolio, the top 20 most valuable private companies, they grow between 30 to 100%, or the AI companies eat like like a couple of 100% per annum. So I think as an investor, if you don't want to be left with kind of, with the, I don't know, Magnificent Seven, right? And otherwise lower growth, you will need to invest in private markets. I mean, not all the private markets, but because private markets are infrastructure, private debt, or buyout, etc. But when you look at like growth, those are the companies that you should have in the long term for many, many, many years. And while it's risky to bet on one single company, because you will not know if that's going to make it. It's just like if you would be investing in the S&P 500 or Nasdaq 100 over 20, 30, 40 years, you'll be just fine. Or also on average, right? And if you can invest in all 20 top 20 companies, for example, you'll be just very, very fine. I agree with Nicolas' comment that a lot of the return is likely going to be eaten away if you have funds with carry and you have fees on committed capital, which is actually not put to work, right? You're paying for something that's not actually working for you. But if you have low cost evergreen funds that are invested in like top tier companies that can grow, I think there's not so much you can do wrong over a longer time horizon, like 3, 5 years, 10 years plus. And so everyone should consider those if they can afford to hold them in terms of the liquidity, diversification, and so on.
Andreas, I don't want to get too micro, but we had a comment here in the chat that there's a perception that Stableton is expensive, right? And without going too micro, you might want to explain actually how the fees work at Stableton, because it's much better value than investing in a VC fund. So maybe just if you want to have a right of reply to that comment in the chat.
I think there are like subjective points of view maybe on some of those deals, but in general, if you think about if you're giving up 20% just for the carry already, right? And then it makes sense if you are in early stage where you deliver a lot of value and basically you can make up for that 20% performance drag because you're really kind of shaping the future with your actions. However, in blue chip private company investing, where those companies just continue to perform regardless what kind of investor they're going to have, then I'm not sure if you are supposed to pay that. And I see that as a ratio of expected return. So if you are just like I don't know, 15-20% maximum per cost per expected return, I think that's okay. And that you still end up with superior long-term expected return after fees, I think that's good. And then it's basically also the service that you're providing, like the ease and like that is available, that can have liquidity, that is mark to market, that has reporting. So these are all items that you're paying for. But I mean, of course, everyone should decide for themselves.
Karine, can any large diversified portfolio afford not to have an allocation to private markets?
Now, this, and let me put some context because of the comments that were made earlier. But indeed, so here I'm really talking about people who, from a regulatory perspective, can actually afford to be in private markets, right? I'm talking ultra high family office, people who have 50 million plus of liquid assets at disposal, and the idea here is you want to build a portfolio. It's not about one, just a token. It's really about having a portfolio approach. In your portfolio approach, you want to make sure you have access to as many potential and the source of value of returns across asset classes. Traditionally, you do have an allocation to alternatives, and namely illiquids. You do have to have that. It's part of your diversification profile for a portfolio, soundly built portfolio. Now, which portion of your portfolio is for debate, but that is key to your diversification. But I think, and that's what we've heard from the different panelists also, is we're accessing now not just the liquidity part, but also a different stage of the company. Now, with secondaries, with private equity, with the fact that companies are staying private longer, in fact, you are in a more static, or for the last few years, a more static part in the public market, more concentrated, more static, less new blood, and in the private equity market, you can actually access a stage of growth, which is not just early growth of the typical private equity, but in fact a time in the company stage which is of very high growth. So that's super important because traditionally we've accessed for clients, for private clients, we've accessed that pool using private equity funds, and in fact, a fund of private equity funds to make sure we're diversified enough and where we rely on the expertise of the selector of the funds, and then on each of these funds' capacity, expertise, and access. So it's still very restrictive, and in the space which is illiquid, you only get a portion of the actual market. So it's biased. You do need, so you answered your question, long answer, but yes, you've always needed that private equity exposure. It's for you to decide how much. This is the real question is, how large you want this to be. But I think what has been changing is in fact what you access through that private equity bucket. Is that an answer then?
And then, no, that's a great answer. And then just maybe as a follow-up, which is, in your mind, what determines the size of that private market?
So typical, what's your risk appetite? What is, and again, we need to redraft. It's everything depends on what your objectives are. So, it's always super important to look at this access, not just because you want to access, but because there is a return to be gotten from these asset classes. This is what we're after. We want an actual return. We build a portfolio for a specific return, and you want to be on the efficient frontier of risk. For a specific risk profile, you have a specific asset allocation.
But do you think that allocation grows over time because, as we've discussed, you need private markets are becoming more and more important to get access to growth, and secondly, because as there's more liquidity, maybe the illiquidity premium disappears or shrinks over time?
Listen, in the past, 2 decades, maybe we've seen in client portfolios the allocation to illiquids grow considerably. Historically, there's been a lot of hedge funds, then hedge funds have been out of favor, so it's been more on the private, real estate, infrastructure, private equity. And then there's been this huge revolution in the endowment world, with the Yale model, which has claimed some IRR numbers, which, as you probably know, are completely misleading in the private equity world. So people have been emulating these allocations. The bottom line is, and then there's been a lot more in everybody's portfolio because there was more supply. I mean, just to put it honestly, people have been producing more, and there's been. But in the end, the bottom line is you have access to more of an investable world producing returns. Again, we need to take the point of view of the investor. What I want for that portfolio is to produce returns. So how do I go to that? And that is the most important. So we have more access. If you have more access, you have more liquidity. Liquidity is incredible input to make sure you compute your asset allocation right. You need to take that into account. So obviously, the fact that there is a better secondaries market, and I'm not the expert to judge the quality of it, but certainly it has increased over time, clearly makes the case for more allocation, or at least a more controlled allocation in the private, in the liquid bucket. Let's call it like this to be very broad.
Thank you very much. We're going to move into the last section, which is the outlook for private markets. I think some of this we've already covered, but Nicolas, I want to come to you because I don't know if you guys actually, as in the panelists, can see the polls. But anyway, the fourth poll we asked was about what is oh, here we go. You can see them now. So the fourth poll was about whether shrinking IPO markets are positive or negative, right? And the overwhelming consensus is they're either basically neutral to negative, right? So with that in mind, how do we get more companies to go public? Can regulatory change help? Can we reduce some of the burdens that are placed on companies that go public? Because at the moment there's such a disparity, right, between being private and being public in terms of the scrutiny you're under, all the regulation you have to cope with. So first question to you, Nicolas, how can we get more companies to go public?
That's a tough question. I'm not sure I can answer it, but what I'm sure of is that over the next years, we'll see a discussion nurtured about how do we achieve that. What has been of interest to me is the big bangs that happened on major financial in major financial markets back in the 1970s, 1980s. There was the May Day on the New York Stock Exchange in 1975, if I'm not mistaken. There was the Big Bang in London in 86. The year before, there was kind of a Big Bang, more evolutionary in France, following a report to the finance minister then, who was a socialist, but decided to liberalize financial markets anyway. And the problem that all those transformations or changes or big bangs, whatever you call them, the problem that they were all trying to tackle was the fragmentation of financial markets. Because the more fragmented those markets are, the more difficult it is for asset allocation to reach an optimal level, the more difficult it is for economic agents to access funding, capital, under the form of fixed income or equity or whatever. The more difficult it is to spread risks and to mitigate risks, and that this is why most of those big banks aimed at facilitating the derivative market. And so when I take a step back these days, what I see is high fragmentation. We've been discussing about fragmentation only today between private markets on one hand and public markets on the other hand.
Do you think the political will exists to create a pan-European stock market? Do you think Donald Trump can galvanize us into that kind of action?
Well, I'm sure we're all underestimating what Donald Trump can galvanize, can inspire in terms of a reaction or response to his actions. I can understand the European pessimism at the moment, but what history teaches us is that there's always a response and a rebound and some kind of reaction. Action is always followed by reaction. So what I expect basically is that at some point there will be calls from the players themselves that financial markets are too fragmented across many dimensions, and the fragmentation between private markets on one hand, public markets on the other hand, is only one line of fragmentation. There are many others, and the calls will turn into a policy discussion at the level of each ecosystem or each stock exchange or whatever. And some countries or some ecosystems, not all of them, like the previous time, will decide to go all the way to removing the fragmentation altogether to achieve a critical policy goal, which is maximal depth of financial market, which we don't have at the moment, which means there are many issues and concerns about misallocation of assets. And that's the problem that will be tackled one day or another, I expect. And when that problem is tackled and hopefully solved, it will make the separation between private markets and public markets maybe not disappearing, but more blurry. Like we'll try to take the best of both worlds, like and there will be a new synthesis that and on the other side will emerge with new public markets that are not much in common with those that we know today.
Thank you very much for that. Andreas, I'm going to come to you next. So I wanted, first of all, anybody can comment on this. If you go into the chat, hopefully you can see that. There's a long comment from Alexandra. I'm not going to read it out, but the whole thing. The premise is actually in the end there's not that much difference, right, between investing in public or private markets. So maybe that follows on from Nicolas' point. Maybe the increasing liquidity and more platforms like Stableton make it such that we don't draw such a sharp distinction between public and private markets. But So I wanted to get your comment on that, Andreas, and then also your view on how big private markets become relative to public markets over time.
Yeah, I think especially when you think about equity investing, regardless if it's public market equity investing or private market equity investing, long term, you're generating exactly what the company is producing in earnings times a multiplier, right? So, so regardless, whatever you do. So that's why I don't like to have the segment is the market doing well, or kind of it really depends what companies are you looking for, if you're just taking looking at the average or not, and why are you sometimes paying high multiples for some companies and sometimes low for others? It's just because they are growing faster, they're higher quality, they have more in target margin that they can, and hence more profitability that they can achieve. So I think that's what sometimes people forget, and then regardless kind of which market it is in, they should be holding these great companies for the long term, right? And now, how do you do that? Of course, in public markets, it's easy. You just buy a, I don't know, value ETF or whatever, like an NASDAQ 100 ETF, and you hold that for the long term. And that has been difficult in the private markets, of course, because you cannot build a diversified portfolio. You just have to bet on single funds, and you don't even know what that fund is going to entail, right? So that's why I think that is some of the innovation that's going to come, that it's easier for an investor to, in general, participate, hopefully in those great companies, to hold for the long term. And I think you could also argue, well, meme coins, meme stocks, CFDs, all of those should be forbidden in public markets. Why can retail investors do all of that, right, and lose tons of money? Yeah, and you're not allowed to participate in, let's say, diversified portfolios of private companies, right? But I agree there is going to be likely then some kind of regulation also coming to secondary markets. There will be, I saw another comment, there will be newer forms of funds. For example, I'm going to do a LinkedIn post, but the GPLP fund structures were invented before movies were in color, right? So it's just a long time ago, and so it really, there is also some product innovation needed, including evergreen funds, semi-liquid, mark-to-market valuation, passive, right, lower fees, and all of that, and that will all help. And so there was another great comment from the Shopify CEO Tobias Lütke. So once you remove friction, the market volume will also thrive and grow significantly. And that's exactly what's going to happen. Once we allow the wealth channel to participate, banks, wealth managers, more investors, it'll be completely different. So, it has already been thriving in the last 5 years, despite an IPO draw, despite really hard time for private markets. But now if you think of let's say, better products, more information, IPO window opening, I think it's just going to thrive. And then basically it's great to have some exposure. And for anyone that doesn't have the exposure, like banks and wealth managers, for example, their clients will just go away and go do it somewhere else, right? So yeah, that's basically what investors are going to expect the more they read about those things everywhere.
Fantastic. So, with huge regret, we're actually out of time. So we're going to have to wrap it up. I knew that would go really quickly because we're trying to cover so much ground in such a short space of time. And actually, I think we were there wasn't broad consensus on whether or not we're actually in a secular decline when it comes to IPOs. There wasn't broad consensus over the outlook for pre-IPO stocks and growth stocks, whether we're in the 1800s or the 1970s. But there did seem to be at least broad consensus that private markets are becoming more liquid, and that seems to be a secular trend, and probably they're going to continue to grow relative to public markets. So I just want to take a moment to thank everybody for joining, for all the excellent questions that we received during the session. And then, most of all, I want to thank our panelists for giving it their time and for their really insightful answers and responses. So thank you very much. And I hope you all join us for the next 4x4.